The mega caps are seeing the biggest losses amid the recent sell-off. The 30 largest stocks in the S&P have collectively lost nearly $3 trillion in just the past couple weeks. For comparison, the remaining 470 stocks lost about $1.5 trillion during the same time span. Within the Mag 7, Nvidia shed more than $600 billion in market cap. Apple, Microsoft, Amazon, and Google parent Alphabet each shaved more than $300 billion. And despite all this, my next guest is buying the dip in big tech. Mark Avallone is president of Potomac Wealth Advisors. Mark, I'm surprised. Tell me.
Well, I don't know why you're surprised. Those are some of the best companies in the world. And yes, they were a bit overvalued, but look at the valuations today relative to last week. I mean, up until last week, everyone was talking about AI and technology and the investments companies are going to need to make in cloud and in security. And then within a week, everyone's worried about tech. I think the move yesterday makes it healthier now to invest in technology. We think even if the economy slows, that's more of a reason to buy into the growth trade, to buy in technology. Companies cannot sit on the sidelines and not invest in those important areas. So we think even a slowdown, this is where the growth's going to be and where it's going to be resilient.
Okay, so I joke a little bit about being surprised, but I think of you as a stock picker, someone who's kind of trying to look through the momentum crowd and focus on fundamentals. And obviously, I mean, some would argue big tech are the new consumer staples, but there's plenty of people who think the AI trade simply got overdone and those valuations were too high.
It may have. But look at some of those names on the list, Amazon and Apple, Meta, and there's plenty of other tech names, broad-based. We like broad-based technology, broad-based tech ETFs, some of the more equal weight. You know, a lot of people think they're buying technology when they buy the XLK, the biggest tech ETF. That's 45% in two names. And we think that that's not a prudent approach. We like a broader base. We don't want our clients to be exposed to something like CrowdStrike, which is down 40% in a month. I know it's fancy and it sounds great to throw out names and to pick them, but the reality is unless you're deep in the inside, you don't know what's around the corner. And CrowdStrike is a great example of why we like broad-based, more equal weight tech ETFs and not an overweight into mega cap.
It's a good point. Okay, so do you think the market, broadly speaking, is in a rotation? Is it in a defensive tilt? When I was looking at Lockheed yesterday, one of the few stocks to make all-time highs, and saw you were coming on today, I was reminded of your defense picks, but that was last year. So curious how that fits into what you think is going on in the market, if it does.
Okay, well, one of the reasons we like defense, and a great memory because we debated that a few times, was because when you look for true diversifiers, you want things that don't run in the same direction with, for example, mega cap tech. And defense is going to run on its own. And unfortunately, there remains a need for this globally. And a defense sector ETF would be doing a lot better if they didn't include Boeing. If you take Boeing out of these big defense sector ETFs and you look at the underlying components, the other main components such as a Raytheon or a Lockheed, you'll see that this has been a good place to diversify away from technology. And that's why we liked it. And that's why we think investors should still consider it. It gives them a buffer against tail risk, unexpected events, and that's a good construction in a portfolio to build it out that way.